Alright, ladies and gentlemen, let's talk about what we can expect out of the markets heading into the future. We're talking over the next coming days, coming weeks, coming months. There's a lot that we need to discuss here in this video, and I want to talk about some of the moves I'm making in my portfolio, how you guys can take this really bad situation and turn it into a massive wealth building opportunity. So we're going to get into all of this information. Yes, we are going to talk about our favorite stock here in this video as well, but in the meantime, hit that like button, subscribe to the channel, source your comments, questions, or concerns down below in the comment section. Get your free stock with Webull, Moomoo, and Public, link down below in the description as well. So let's talk about just briefly what is happening today. We've talked about that in basically every video we've made today, briefly, why the markets are falling. But essentially, it's because the markets don't agree with the Fed. The Fed is saying everything is okay, GDP looks good, we're not expecting the unemployment rate to tick up, we're not expecting bankruptcies, the economy can handle quantitative tightening and raising rates. And the data that we are getting just doesn't support that. Real estate, bad data came out today. Bad weekly jobless claims numbers. Just bad data overall. We had a negative contraction in the economy of 1.5% for Q1 2022. We're not anywhere close to what the Fed is projecting. So the markets right now are saying, hey, the Fed thinks this is going to happen. The data's coming in like this. The Fed's going to push too hard, make a bad decision that's going to push us into a deep recession, and it's going to take a long time and a lot of pain to inevitably come out of that. You are also seeing Revlon that did officially file bankruptcy today, so that is not helping the situation. So that's what we're currently faced with as of today. In what we do know, yesterday the Fed raised rates by 0.75 basis points. That was the largest rate hike increase in over 30 years. Now, what happened yesterday is essentially the markets closed up pretty well overall, right? The markets closed up. The SPY, the S&P, was up over 2.5%. The NASDAQ was up almost 3%. Well, what are you seeing today? The S&P's down 3.22%. So even though we rallied yesterday, we are still at the lowest point now of 2022. We have given back all of those gains that we seen yesterday. And this is exactly what happened at the last Fed meeting, which was May 4th. And what happened the next day was pretty much the same exact thing is what is playing out right now. So May 4th, we ended up closing the day up 3.05%, the day the Fed raised rates by half percentage point. A lot of shorts covering, a lot of just that initial relief rally because the fear catalyst was gone. And essentially at the last Fed meeting, the Fed took 75 basis points off the table. And just over the last 2 days, the markets have went from not pricing it in to pricing it in. We got that rate hike, and that's also not helping things, just showing that the Fed is really willing to act more aggressively. Even if 2 days the markets go from not pricing it in to pricing it in, it's not a good sign, okay? But then the next day after the Fed meeting, May 4th, what happened? The S&P dropped 3.55%, literally deleting all of the prior day's gains plus some. And then what happened from there? The markets fell another 0.60%, 3.2%, and then rose a little bit, 0.23%, and then did fall another 1.6%, and then did ultimately fall about another 2% at the low of the day, May 12th, and then inevitably did almost recover all of those losses. So we did see from essentially the Fed meeting, potential like where we are right now, from the low to the low following a couple days after that was a decrease of about 5%. So if something like that were to happen from where we currently sit as of right now, that would put us roughly, let's go down 5%. That would put us roughly at the 346 level on the S&P. That's kind of what I expect to happen this time around. I'm not a fortune teller. I'm not going to stick my neck out on a line here, but that would put us pretty damn close to the peak pre-COVID that we've seen. And that's ultimately, in my opinion, going to be the low of the decade, around 325, 330 on the S&P 500. So there is still a little bit of downside left over the next coming days and coming weeks, in my personal opinion. Now, we might bounce up, we might bounce around a little bit, it might take a little bit more time than not, but I do think there is a little bit more downside. We are also seeing crypto hedge funds getting margin called, becoming insolvent, even Celsius becoming essentially insolvent, and you are seeing a lot of bad hedge fund news that is specifically coming out today. And over the last couple of days, hedge funds are selling stock at a record pace to meet these margin calls, so on and so forth. So once margin calls start, like it looks like they are, you're seeing a little bit more capitulation over the last couple of days. That's when you start to get into no man's land. You start to get those margin calls. It starts to push the markets down to extremely oversold levels, and then eventually you will see this. It's kind of like a rubber band, right? You stretch a rubber band so far and it's slow, the process is slow, and then once it snaps back, it's like boom, right? You're going to see an eventual market rally, but it's going to come down to data, because the Fed, if they can switch up within a day or two and essentially go from, not being as aggressive to ultra aggressive, if the data switches, maybe the economic situation gets even worse, or maybe just inflation looks a little bit better. That's where you're going to see which direction the markets are ultimately going to take. I will say right now, you are much closer to a bottom than to a top, given the NASDAQ is down about 32.5% to start off 2022. So this has been one of the longest lasting downtrends that we have seen in a very long time. Now, with all of the fears of a recession, you guys got to keep this in mind. The bottom happens before a recession most of the time. So if we take a look at what actually happened during something like 2008, what happened with the federal funds rate when we actually went into a recession? Well, we went into a recession December of 2007. If we take a look at the S&P 500, go back to 2007 in December. Let's see, it'll take just a second. December of 2007. We were over here, and it was quite rocky. It was a little bit different, though, because we were off a decent amount from the highs once we did go into the recession. Draw a trend line down. We were down about 10 to 15% from the high that we did see October of 2007. Went into that recession, just call it the beginning of 2008. The markets did crash. This is what this essentially was, this downward move, and that was probably about 20%. Yeah, that was almost exactly 20% from the highs, which is a bear market. That's what you would expect to happen. Now, once we went into a recession, we probably would have bounced back out of it if it was not for the financial crisis, in which the markets obviously dropped a lot more from the peak to the low, dropping about 57% on the S&P 500. Minus the financial crisis, we probably would have recovered a lot faster, and just given when we went into a recession, you actually did start to climb back up after that until the financial crisis actually happened. And if you look at this and historical data over, the last 50 years, when you go into a recession, usually that is peak fear. Usually there's a lot of fear about what could potentially happen. The economy's never going to recover. It's going to take 10 years, so on and so forth. And then the markets just sell off in anticipation of that, and then the data starts to come in that's not as bad. Things do ultimately tend to rally from there. So I do think once we go into recession, it's going to be in 2022. It's probably going to be Q3, Q4, go into a technical recession, and then likely in the first couple months of 2023, that's when you're going to see the ultimate bottom reversal, and then we will start that steady up climb back to all-time highs. Now, it's not going to be a V-shaped recovery. We don't have the Fed, so don't expect something like this. It's going to be more like 2008, taking quite a bit of time to ultimately get back to those all-time highs. I believe it wasn't until 2012 where you actually did break out of a new all-time high that we set in 2007. So I do think that's very possible, but there was a lot of millionaires that were created during the great financial crisis. More millionaires are created during recessions than off of lottery winners by a long shot. So if we do get a multi-year downtrend where it takes a long time to get back to all-time highs, which I don't think it'll be quite that long, that's where you want to accumulate these positions. That's what I've been doing. I've been buying a lot of stock in my favorite companies: Square, DraftKings, PayPal, Sofi, Snapchat, a lot of other stocks, Spotify, even Tesla, buying into these quality companies and essentially building out positions, acquiring more and more shares each and every single week, to be in a really good situation 5-10 years from now, when everything does bounce back with a fury. The markets are going to be in a much stronger place once we do get through this shit show that we are currently seeing. So that is the single best thing you guys can do as of right now. Now let's get into and talk about our favorite stock, which is obviously SoFi stock here on this channel. SoFi is currently trading at about $5.50 per share. Now I do want to point out other fintechs like PayPal and Square, essentially SoFi's competition, they are hitting new all-time lows, whereas SoFi is not hitting those new all-time lows as of yet. We are still about 60 cents off of the all-time low, and I think that shows a lot, specifically in the fintech sector, because Square, PayPal, they are all hitting new fresh all-time lows, or multi-year lows, let's just call it that. Now SoFi stock also has a lot more going for itself in terms of bullish activity from insiders, and this is what makes me very, very bullish on specifically SoFi stock, is because all of the insider buys that you have been seeing, Ortex has their insider momentum at a 100. So there's obviously a lot of insider momentum with SoFi stock. We go over the insider buys all the time. There's also a lot of shorting activity, more so on SoFi than even Square or PayPal, because obviously SoFi is more risky, right? They're not profitable in the same way that specifically Square and PayPal are, but there's a lot more potential reward with SoFi stock. If SoFi does become the Amazon of finance, like people like to say SoFi can become, they're only trading at a $5 billion market cap. If this stock 10x's, that would be a $50 billion market cap there. That is very possible in the future, and that would take a $10,000 investment to a $100,000 investment. That's a pretty good risk to reward, even considering that SoFi has been doing very well on a fundamental basis, and the stock could easily be acquired by a larger company for double what the market cap is currently trading at. SoFi could be bought out for $10-15 billion market cap. So that is a very real possibility, and I think that is what inevitably could happen if the overall financial conditions continue to get bad. But I think SoFi has a lot more going for itself because of how diversified they are, right? The investing platforms, they have multiple different products, but their largest business segment, which is student loan refinancing, has been shut down, like we've talked about many times here on this channel. That is not a secret, but in 2023 people will have to start paying back those student loans, and that will drive the revenue and the profits at SoFi in 2023 and 2024, and that is when you will see a very positive return on your investments, in my personal opinion. Now let's talk about the data behind SoFi stock. SoFi is down about or not down, but their short interest is about 16.2%. Current shares that are sold short of about 118 million. Cost of bar max at about 4%. So not really implying a big potential upside or downside move from the cost of borrow rates in the near term future. 100% share utilization. People do not want to lend out their stock as of right now. Shares out on loan 183.52 million. That is down about 5% over the past 7 days. So that is bullish, and now only about 25.23% of the float that is currently out on loan. So there is about 9% of the float that could be sold short against us at any time, and I do think that's just a lot of short-term hedges. You've seen a lot of long-term positions that have been initiated on SoFi, but you're seeing a lot of these longer-term put options that are very, very close to the money, worth a lot of money as well. A $2.7 million position. That is a June 2023 $5 put, for an example here. So a lot of long-term positioning, a lot of multi-million-dollar share positions, but at the same time these hedge funds are buying a lot of insurance, they are buying a lot of puts, and that is helping to keep the price of the stock down in the short term. So keep that in mind. I do think there is short-term pain and long-term gains when it does come to SoFi stock. So that is going to be all. The biggest thing for SoFi is you really want to watch the bond market. If we take a look at the bonds for the day, bond yields are actually down 0.15%. So it's actually surprising to see the bond yields coming down today and the stock market down in a big way. But usually when the bonds go up, SoFi stock is going to go down. When the bonds go down, SoFi stock is usually going to go up. So I think it could set set us up for a pretty decent move, pretty decent potential rally over the next couple of days if and as long as we don't go through that same 5 to 6% downtrend that we seen last time after the last Fed meeting in the market. So could go either way. I'm not a fortune teller, but thank you guys for watching. Hit that like button, subscribe to the channel, source your comments, questions, or concerns down below in the comment section. Get your free stock, Webull, Moomoo, and Public. If you have not done that already, I don't know what you guys are waiting for. Not too many things in life are free, especially in 2022 where inflation is eating away at your purchasing power. Nonetheless, thank you guys for watching, and I will see you in the next one.